Microsoft shows that AI isn't just a future concern, but can be profitable right now. Welcome back to the AI Breakdown Brief, all the AI headline news you need in around 5 minutes. And we have a very Wall Street / big tech centric AI Breakdown Brief today. We have one big tech stock that has cratered on AI plans, one tech stock that is soaring around AI, and one big tech stock that's doing pretty well, although how much it's AI versus other things isn't exactly clear. Let's start with the stock that's doing well, which is Microsoft. In reporting their last quarter earnings, Microsoft beat Wall Street estimates. Analysts had been projecting $60.80 billion of revenue and earnings per share of $2.82, reaching $61.9 billion in revenue and $2.94 earnings per share. That is a 17% jump in revenue. All told, the company's shares increased by more than 4%, increasing the company's market value by $128 billion. Now, right at the center of the story of why they were doing so well was, of course, generative AI. Said Brett Iverson, Microsoft's Vice President of Investor Relations, "We're continuing to see customer demand grow quite a bit, and so we're making sure to scale our available capacity in line with that." Now, of course, where this comes home to roost is in Microsoft's cloud business. That's the division through which they're offering these AI capabilities. And if you look across the last year, you see that Microsoft's Azure has flipped and grown ahead of Google Cloud and is also significantly outpacing AWS. Revenue from Microsoft's cloud unit rose to $26.7 billion, which once again passed Wall Street analyst bets. Azure revenue overall grew 31%, and Microsoft forecast that its growth for the next quarter would be 30 to 31%, with revenue of $28.4 to $28.7 billion, which would put it ahead of the 28.5% Wall Street growth target. One of the things that has been really notable about AI as a new technology is that because it is being used inside of these cloud businesses as a way to attract buyers to these cloud services, it actually has an outlet that Wall Street can understand in dollars and cents terms right now. In other words, Wall Street doesn't have to be super forward-looking. It can understand the value of investing in AI right here in this moment. And indeed, what we saw around Meta stock suggests once again that Wall Street is not the same as venture capital. They are not imagining what might be in 5 or 10 years, but instead they are looking very much at the here and now. Meta also reported last quarter's numbers. First quarter profit more than doubled year over year, and revenue was up 27%. So why then did Meta stock fall by as much as 15%, wiping somewhere between $180 and $200 billion off its market cap? Well, it seems like it was all about its projected AI investments. Meta increased its predictions for what it would spend on AI investments by $5 billion this year. Previous guidance had suggested that Meta's full-year capital expenditures would be in the range of $30 to $37 billion, and now that's moved up to $35 to $40 billion. Said one analyst, "The language around spending plans has become bolder once more, and this could be what's spooking markets. For all Meta's bold AI plans, it can't afford to take its eye off the nucleus of the business, its core advertising activities. Meta's resources are vast but not infinite, and its digital advertising market share needs defending at all costs." Now, it wasn't just that Meta was talking about its big investment in AI. Zuckerberg was also preparing investors for the reality that he saw, saying that they would be increasing spending, quote, "meaningfully before we make much revenue from some of these products." He did also note that the company has a, quote, "strong track record of monetizing new services effectively." But ultimately, as we've seen over and over again, Zuckerberg is going to do what Zuckerberg is going to do. Wall Street and everyone else be damned. Then there's Google. Google is up nearly 11% as I record this, after reporting a 15% rise in revenue from a year before, which was more than 13.5% rise the previous quarter. Now for this one, the increase in the stock price seemed not to be really about AI. Instead, Google made a dividend and a buyback announcement, and that seemed to be more of what was encouraging this jump. Indeed, as the Wall Street Journal writes, investors are closely watching for signs of whether and how the tech giants are reaping new business from investments in AI programs that can generate text and images. Google, in particular, has faced persistent questions about its ability to defend its business model, which relies heavily on search ads as more people turn to chatbots for answers. Google has offered few specifics about how AI is affecting its sales and profits. Multiple analysts asked CEO Sundar Pichai on a call Thursday for more details on how AI is improving Google's financials. Pichai said Thursday that the company is encouraged by an increase in search usage among people trying its new AI tools, but he otherwise provided little in the way of metrics on the technology's business impact. The role that these big tech companies are playing in an emerging technology movement like AI is really different than what we've seen before. The normal pattern is that some new types of startups create some new types of usage patterns, which eventually get acquired into big companies or become the big companies themselves. But the sheer capital needs in the AI space is making this a little bit different. There are other factors beyond capital as well. For example, I think large enterprises, because so much of the value of AI lives inside how it interacts with their data, are more inclined to trust companies that they're already working with, rather than new startups. Still, part of the reason that I spend so much time on the ebb and flow and the fortunes of these companies is the way that they treat AI will have a big impact on how the rest of the world does. For now, though, that is going to do it for today's AI Breakdown Brief. Next up, the main AI Breakdown.